Good morning. I'm Roy Weiler, the Director of Trading Operations for Time Leverage Capital. Anyone who missed our previous webinars, give us a call at 800-519-9085. We can send you the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now for an important disclosure. Please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends and All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Hot Markets Friday webinar. Mr. Mueller.
Thank you for the introduction, TGIF. Thanks God it's Friday, and it's always good to finish the week, I believe, on a positive note and trying to learn more about something that's important to us, which is ways to handle the market seems like a good way to start. So today, we're going to be having a look at the bond market. So we're going to have a look and imagine, if we will, and let's start with one of our basic calculators, which is the beginner calculator. Be sure to go through all the demos and the complete lesson plan if you're not quite sure where you are on the continuum of understanding different types of trades or what types of things you need to learn. Be sure to set up a short conversation with myself or somebody in the developer group so that we can point you to the right areas. So let's begin right now with a scenario. As you know, whenever we try to come up with a scenario, we go into our strategy gallery, which provides us with a way of defining trades in a more complex and appropriate manner. Most people strictly make decisions based on direction. As you know, markets can go up, down, or sideways, so clearly that is something that is a factor in most people's decision making. Something that should factor more in a complete trading decision that is more nuanced to an opinion is to also input to the greatest extent possible the other big element in speculation, which is volatility. Is volatility going up? Is it going down, or is it going sideways? So you should really have in mind a forecast of those two items before you contemplate a way that you will approach a market, ideally. And that's what we intend to measure here. Today we're going to make up a scenario on the bond market and interest rate. We're going to look at the 30-year bond, and we're going to show you those contract specs shortly. We are not recommending a particular trade, but there's a lot of excitement. There's geopolitical concern. There's concern about the printing of money. Opinions are going in every direction, and there's a sense that something, somehow, could happen in the bond market, perhaps one way on geopolitical instability, perhaps another way on the printing of money and effects of money supply. So somebody who thought that bonds were going to go up would have a bullish outlook, and if they thought the volatility would be rising. So let's say whether that is a geopolitical event or some other kind of flight to safety event that would cause people to run to what is perceived as a more secure instrument, a bullish person with a rising volatility outlook would look to buy a call. You'll see here in our strategy gallery the particulars of the trade, and again, it'll show much more intuitively on the spreadsheet that we're going to see shortly. But as you can see here, the profit scenario for purchasing this particular option is that it requires a move to be to the upside with rising volatility in order to overcome premium costs. So again, the basics, the direction, this is a directional trade. You think the market's going to go up, you think the market's going to go up big. Trade has an unlimited profit potential, and the risk profile is limited to the premium and fees paid. So your total debit when you start is the maximum loss. This is one of the reasons why buying options is one of the more popular strategies for newer option traders or traders who don't really want to get involved in margin or more complex transactions. The big minus to this transaction, as most option buyers will tell you, is time decay. The position is a wasting asset, and unless you do get your big move with rising volatility, time decay will do a job on that option, and the premium could be lost or lost in its entirety. Now let's actually go ahead and have a look at a couple of option trades using our basic calculator. And we've already saved this a bond trade, which is the one that we just discussed, which is buying the 132 bond call. Whether or not you know much about this particular market, you can look at this page and get to a lot of information. Number one, we have recreated in at a glance form the profile of the trade in terms of the volatility expectation, which is up, the directional expectation, which is up, and a graphic of the effects of time decay, which will be a quick way to trigger your memory of what the trade is intended to do after you get familiar with those details and see a certain number of these spreadsheets. Again, the trade is defined. The trade is input here. You can also input it yourself. We have demos on how to do it, or we can save your tabs. As you can see, you get the contract size, the tick values, and if you wanted to know even more about bonds, there's a dialog box right here with the complete contract specs and a section on what you need to monitor in order to trade the bond market. And in fact, just for a moment, let me go ahead and go to that page. So those of you who are not familiar with trading the 30-year bond, which is a huge U.S. government instrument, here's the value of the units, the trading unit size. That's how much you're leveraging. It's a powerful contract, and you have to be mindful of how much you are leveraging if you're using leverage. And in this section here, you have to what to watch, which is consists of a lot of the factors we have compiled over the years of items to monitor if you really want to follow this trade extraordinarily thoroughly. And in addition to listing the various factors, if there's a primary source that updates or reports on this information, that primary source is listed right there. You can go to it and see the information. So you can really go at a market from the market section, where you kind of look at the updates, see decide which of these things you want to monitor or look at before you get in. You confirm your trading hours, and of course we have that online elsewhere as well. And then you can go to your strategy gallery and select your trade. So let's go back now to the trade. So you see how the contract spec works. When you input a strike price, which is where you have the right but not the obligation to buy the contract, again, you get an example and another dialog box that takes you to an explanation. Paid 1.32 in premium. Costs are input because when you do business, you want to make sure you have all your costs calculated. I'm going to expand the number of rows to see this trade here, and let's go ahead and calculate the trade. And then the wonderful thing is that although bonds trade in these unusual ticks and different values, buying an option at 1.32 in premium, you immediately get a translation in the values. And just a moment, and then we go ahead and go down. You have the factor of cost that is input, and then you have your final debit. You have a credit or a debit on the trade. In this particular case, you are working with a debit, as we had indicated, and then you have a futures break-even point, which is the intrinsic price on the bonds that will have to overcome that premium at expiration, and also a premium break-even point on which you can get quotes all the time. And again, everything is translated both into premium points, which is how the contract is quoted, but it's also translated into dollars and cents so that the risk and reward register with us in the manner that we are accustomed. We list again the maximum loss in red because the number one thing a person should look at is the level of risk in a trade. So the software is objectively designed not to mitigate risk or to make one thing look better than the other, and you're going to see the opposite of that in the next trade. So here this person expecting the market to go up explosively is expecting bonds to really take off, and let's see where we go here. Just a moment, and let's go down the grid of where this bond trader makes money. As you can see, if there's some kind of a serious incident of instability and bonds go up explosively above the strike price that this person purchased, which is actually an out-of-the-money option at this moment. The futures market is trading around, trading around 131 and 7. So again, this is an anticipation of rising volatility, and if something happens, there's a flight of capital to bonds, and it's not out of question to see bonds at 134, perhaps on some real flight to safety, a major number. So this would be a play for somebody under some circumstance thinking that bonds have to go up. Because, and again, some people are concerned about geopolitical instability, so this to some extent is a nod to that type of person. Whether or not they're right, they'd have to look at this table and say, if the market goes down, this is the maximum that I can lose. Of course, the loss is limited. So if there's a major round of sudden inflation, or inflation indicators, or announcements that would be foreboding regarding inflation, then obviously the market goes down. This person doesn't lose more than the maximum that they risk, which is the 1375. So again, this is a limited risk play, but it does require a large and explosive move to the upside. So if somebody thinks there's that rising volatility in that direction, that's how they can trade it. Now, along the same lines, we did the opposite example. So now we're going to have a different scenario, and we can go back to our strategy gallery in a minute, and imagine the entirely opposite scenario now. So we have one person that thinks that bonds are going to go up because of fear and panic and flight to safety. Now let's make up the counterpart is somebody opposite to this person who thinks the exact opposite. He thinks that the money printing and some kind of a crazy announcement that's going to shock the market is going to make the direction go down. And it's not just going to go down a little bit, but it's going to go down a lot with rising volatility. So now we got a totally opposite position of the first guy. The first person thought the market's going to run because of instability or some geopolitical flight to safety. The second person now is going to think that bonds are going to tank because interest rates are going to go up and inflation is going to rear its ugly head. Now the person says, this is it, the bubble's going to pop. So that person, again, would be very bearish. Okay, so the more, again, what class of options is purchased is something we can discuss later, but he's extremely bearish. Again, has unlimited profit potential because he pays a premium. So the profits go up as the market goes down, and the more explosively it goes down, and the faster, the better. The loss is limited to the costs, which is the premium and commissions paid, and again, the trade-off in this trade is that if it doesn't make that big move with rising volatility, time decay is its enemy and can really do a number on this type of trade. So you have to be very mindful when you buy premium that although the surface definition of unlimited profit and predetermined risk is very attractive, you have to really keep thinking time decay and time decay, because a decent direction with insufficient volatility can still lose some or all of your premium. So you do have to be mindful of volatility. And again, this is a scenario for somebody who thinks that volatility is going to pick up. Again, so let's go ahead and go to our next calculator and look at how this person is going to purchase a 130 put. Again, 1 basis point out of the money because he is looking for a big move. By the way, you can look under our reference materials for a discussion of in, at, out of the money options, different classes of options, and also see demo videos on how to monitor them and how to use them. Again, if the pace is a little fast today for some of you, we apologize. We do have our basic programming both in our course materials and in our video library. So again, I love having you aboard, but please, if you need some more basics, set yourself up to follow some of the more basic points. Let's go ahead. We're still on actually one of the basic strategies, which is buying a put. It's one of the pillars of trading. In this case, again, we get the quick visual that triggers our thinking that time decay is a problem, that the direction has to go down, and that the volatility, the bounciness, the panic, the dread in the market has to go up. We have all our contract specs again, and let's look at the particulars of this position. The dollars and cents is $12.50. If you factor in a default at 55, the total cost, which is going to be identical to the maximum loss, the most you can lose is what you initially spent, is right here labeled in the red in the red box. Okay, now, in order to make money on this trade, you have to get one of two things. Number one, futures intrinsically by expiration have to be above 128. Below 128.7. Below 128.7, and the break even in terms of premium means that you paid 1.3, so you would have to be able to collect more than 1.3. Once you get above these two numbers, either intrinsically or, and again, these prices quote all the time, your maximum profit is really unlimited. I'm going to have to make a correction. I think that's a typo there. Well, actually, it's limited because bonds can't go below 0. But I think we would have we do show the amount of the move that is gained. It's 31.25 per tick move below 128.7. Okay, and now let's have a look at the. That's what you do in beta groups. So anyway, we just found something. I'm glad. If you see anything as we go, please point it out to me or send us an email, because we are really on our final stages of cleaning up some of these simple typos. So anyway, so we have the tick value here for the market, and again, as you see, if bonds go down big, the bigger the drop, and I mean, I've seen people talk about 3- and 4-point drops, which seems extreme, but nonetheless, should such things occur or greater, as you can see, the profit potential is pretty steep, and it continues down significantly. Okay, I think I just lost my my visual.
You're still being displayed.
Can everybody hear me? Because I just I think my screen just died.
No, everything's up and working.
Pardon?
Everything is working.
Okay, not my own actual screen that I'm using. So let me just see if I can drag this over to another screen. Just a moment. Okay. Well, I think we're doing such a great job on the software that that my monitor actually just died in the middle of that demonstration. I think this can be an omen either to do the trade we were demonstrating or not to do it. But let me just continue with audio only, and we'll send you a PowerPoint later on just to finish out the three trades. So the examples which we were examining. And I'm going to go to another screen and just pull up quotes so that we can go through it. And if you would be looking, for instance, at that bond trade today, and you said, well, I want to go ahead and I think the market's going to break out, but I don't know which direction it's going to break out. The scenario for such a breakout, and we demonstrated it previously, would be for a long strangle or a long straddle. Now again, this would be somebody who's expecting an extraordinarily explosive move, but no idea which way. So a person, such an individual, would actually combine the long call that we were demonstrating and the long put, which are presently probably still seeing, and combine them into one trade called a long strangle. And although that may not apply to the bond market today, or certainly we can think of a scenario of one of those large incidents in either direction, and a person saying, I don't know which one's going to be, but this thing is going to crack one way or the other, then people like that would go ahead and combine the long call that we just demonstrated, the purchasing of a long call, which we demonstrated, that will be on a tab for you to see anytime if you just log in, the purchase of a long put, which we just demonstrated, which covers them on a large explosive move in either direction, but it has to be large enough to overcome the cost of the two premiums that were paid, which are going to locate in your tab under the master combination calculator.
I'm displaying the trade on my computer. Okay.
Okay, so I'm just going to go on memory, and I will turn this over. So as you can see now, we're looking at the long put. Once you go, we've already reviewed the break-evens. What we're approaching now was the idea of showing how these two trades look combined in a long strangle.
Yeah, that's what I have up.
So I would go ahead and pull up do you have the long, so for those of you who are not sure how long strangle works, you could go to the strategy gallery first so that you get that graphic and a reminder, or you can go say to the long strangle. Now as you can see here in the long strangle, if you were to combine all of the costs of the buying the call leg and the buying a put leg, that will end up being your debit here. So could you go over the particulars of the trade, Roy, and I'll go ahead and continue with the concept.
Sure. Here we're buying the long call, the 132 call, and we're also buying the 130 put. The combined cost of those two options comes to $2,570. When we factor in the transaction costs, the total cost for this trade is $2,680. That also, down here you can see your risk is limited. That is also your maximum loss, what you purchased for the both options, plus your transaction fees. Your premium break-even is almost 3 basis points, same for the high break-even. And what you need is a large breakout to one side or the other. This is straddling the 132-130 area. And you can see once you get below 127.5, that's when you start moving into the profit range. So on a large move to the downside, this will start to profit just after 127, and at that point your profits are unlimited. Same thing on the high side. Let me increase the rows here one moment. And we'll hit calculate. And on the high side, if the interest rates started to drop again, you can see once you get above 134.5, that's when you start to make profits. And as interest rates would go down, you would continue to benefit. If they bonds got as high as 140, you'd be up $5,320.
Okay, thank you, Roy. This scenario, as we indicate in the strategy gallery, is for people who expect to break out with rising volatility, and you should have a good understanding of volatility. We have a volatility video, and we've had multiple requests to have ongoing programming on volatility measures as part of the program. Very important that you log in, have your own page set up so that you can move ahead quickly through a lot of these topics, depending on the amount of time that you can devote. The modules are set up not to be to be used at any given pace, and we have a sense of how long each step should take. The final thing that we want to show, and again, is the opposite of the current trade. So now we're talking about some sort of expectation of rising volatility. I want to show now the opposite of a trade, of the trade that we have right now, which is somebody thought the market's going to go up crazy or go down crazy. Let's say somebody else says, you know what, all this geopolitical stuff is just a bunch of nonsense. Nothing's going to go up. All this stuff about money printing, nothing's going to go down. They're going to manipulate the system. Things are going to stay right here. All these folks are excited over nothing, so they can literally be the counterparty to the long strangle trade that we just demonstrated, which is the opposite, which is the short strangle, where now you're looking for a market to stay in a range or not to really break out excessively past certain numbers. And again, that sounds like a complex trade. I'm trading volatility only. How do you do the math? How do you figure out where to go? So Roy, why don't you pull up again the total opposite of the long strangle, and let's and demo the short strangle and give the particulars, please. If you have a look at...
I'm sorry.
Yeah, are you ready?
Yeah. What
Okay,
we're looking at here is the short strangle in the T-bonds. As you can see in this case, we are selling both legs of this trade. One call, one put. We're using the same strike prices that we used in the previous example, the 132 call and the 130 put, and the premiums, of course, will be the same. When we take a look down here for selling these options, this is the total amount of money that we're collecting, $2,570. We have to figure in our costs, of course, of $110. So the total credit that we're getting on this trade is $2,460. We take a look down here at the spreadsheet. You can see we have a pretty wide profit range from about 134.25 on the upside to 127.75 on the downside. Our maximum profit, of course, occurs if we land between those two strike prices, because then both options would expire worthless. But even if it breaks out of that range, we do have a profit potential on the up or downside. The risk on this trade, of course, is unlimited. Once you get past the amount of money that you collected on the credit, you will start to give the money you collected back, and of course your maximum profit is limited to what you originally collected minus your costs, $2,460.
Okay, thank you very much. Now, what you've seen today, in effect, is the entire range of what can happen in bonds, where you can have a variety of outlooks and a variety of transactions that focus on the range in which you think the market's going to end up. Whether you use a third-party opinion, you do your own research, or you post a question to our forum and exchange opinions with other people. Be sure to use our email to a friend feature, post to a forum feature, and of course, especially if you're participating and logged into the beta group, you're going to have somebody work with you to set up your own tab with the trades that are perhaps more suitable to your interests than the bond hypotheticals that we just demonstrated. And again, we do not want to create the scenarios. We just want to interpret opinions into scenarios, and then the users of the software will be able to do so themselves and continue having a community of interested traders who are going to exchange ideas with them. So we're very excited. We thank you all for participating, and if you have any questions, please forward them. Sorry about the technical difficulties. By the way, first time it has happened, and it was not system related.
Okay, thanks, Mr. Mayo.